welcome to The Money Show, the only show of its kind which brings you the market's top financial experts to answer all of your financial queries every day. I'm Avni Raja, and with me, Avanne Dubash. Hi, Avanne.
Hi, Avni. And yes, we will be answering all of your queries. But in the meantime, let's just walk you through some of the top stories today. The market's first up, and they managed to recoup their morning losses in the last few hours. But we failed to really conquer the 10,300 mark. It was PSU banks, technology, which was under pressure. Realty and metals held on to their gains.
If you're an NRI, PIO or OCI, then you do not need to link your bank accounts or any other services with Aadhaar, as Aadhaar linkage is applicable to Indian residents. That's a clarification that's coming from the UIDAI.
And ET now gets it right as the government cashes in on the phenomenal demand for the Bharat 22 ETF, hiking the option size to 14,500 crores from the earlier 8,000 crores, even as the issue is oversubscribed 4 times. And sources say that the higher proceeds will make up for the shortfall from the lower RBI dividend and spectrum receipts.
Well, those were our top headlines at this point. But joining us today on the show to answer all of your queries is Anil Rego, founder and CEO, Right Horizons. Thank you very much, Anil. Pleasure to have you on the show. We've got a lot of queries lined up for you to help us out with and help our viewers out with. But before that, one important discussion that I wanted to have with you was regarding dynamic asset allocation funds. If you could just take us through what exactly that category of funds is and what kind of investors would it really be applicable for?
Yeah, dynamic asset allocation fund basically is a hybrid fund, which means it has a combination of both debt as well as equity. And unlike, balanced funds which have a standard ratio of say 65% or more, a dynamic asset allocation fund can end up moving the asset allocation depending on market conditions. So there are certain parameters based on which the debt and equity ratio gets determined, and different funds have different ratios. And so effectively, in simple terms, what it does is when markets go high based on certain parameters, the fund goes more into debt, and when markets come down, it goes more into equity. So automatically managing risk and also taking care of the upsides when markets come down. Now you would have a number of funds in this category which you can use. You would have a Franklin India Dynamic PE fund. You have a balanced ICICI approved Balanced Advantage Fund, which is another very popular fund. And you also have HDFC with this dynamic PE fund. So you could use any of them. And so this fund is meant for investors with a lower risk appetite and who do not like to see as much as market volatility. And also you look at this fund when markets have risen already and you're not sure how long it will last. You think it will be volatile, and so dynamic asset allocation funds are an option for you.
Right. And Anil, if you would also give us a sense of the returns as far as this category of funds are concerned in terms of comparing to, say, balanced funds or another category which provides similar kind of returns.
Yeah, so how would this fund do and when would it do better than a balanced fund with a standard equity exposure? You would find that in a market which is moving up very strongly in one direction, a balanced fund may be doing better. You would also find large cap funds doing better at such times. However, when you think that markets are volatile and let's say in a market which is falling, you will find that the balanced advantage fund could even do better than an diversified equity fund as well. And at these times it also definitely does better than a balanced fund. So in volatile times, you will find it's a better pick to take, and otherwise in a trending market, upward trending single direction, then you would use a balanced fund or even a large cap fund.
Okay, that's the view coming in, clearly giving us an indication as to what the outlook is on the dynamic asset allocation funds. Well, we've got a query coming in, and this is via email from Mr. Goman Kant Mahamre. He says, what amount should be invested in mutual funds for a horizon of the next 8 to 10 years for a return of 18 to 20% considering inflation? Can you suggest some mutual funds via the SIP route for the next 8 to 10 years? A mix of large, mid and small cap funds as well. First up, Mr. Rego, do you think that these projections or, wanting to earn about 18 to 20%, is that a bit realistic? And what would you advise him about the ideal way to really go about it?
Yeah, definitely. If you look at conditions like now, when historical returns, if, for a few funds, especially let's say mid-cap funds, are doing pretty well, and you may find very good returns, you tend to project it and say, okay, can I get that 18 to 20%? However, I think while you're investing in equity, it's good to have your expectations a little moderated, because over a period of time you'll find out that there are periods when markets come down, there are periods when markets are flat. So you need to keep all of those in mind, and I think a good expectation is somewhere around 15%. Mid caps may go up to 18%, but I think on an average it's better to plan for say 15%. And what are the funds that you can use? A combination of funds. I'm assuming that the investor is looking at a slightly more aggressive approach, and so you would do a large cap fund, which fund with a large cap bias, ICICI Pru Discovery Fund. You can look at a multi-cap fund, Franklin India High Growth Companies Fund. A mid-cap fund can be HDFC Mid-Cap. A small cap fund can be Franklin Templeton Smaller Companies Fund. You can also pull in a balanced fund like a HDFC or an ICICI balanced fund, and so use a combination of them, as well as when market conditions are really strong, then you can also play around and reduce your allocations, or even switch from, let's say, very high risk funds to lower risk funds as markets are trending very high, and you can always increase your risk in market conditions which are falling.
All right, Mr. Gomalkant, hope you got the answers that you were looking for, and you've taken note at the recommendations that have come in from Anil there. Anil, our next question is from Saurabh Gupta from Jammu and Kashmir, who's with us, in fact, on the phone line. Hi, Saurabh. Thank you so much for calling us. Tell us, what is your question?
Hello, ma'am. Can you hear me, ma'am?
Yes, I can hear you. Go ahead.
Ma'am, I'm a 23-year-old, ma'am, and I'm investing in mutual funds for 2 years, a total of 47,000 rupees per month.
Okay.
And I'm investing 20,000 rupees per month in DSP BlackRock Microcap Fund, 6,000 rupees per month in Mira Asset Emerging Future Fund, 10,000 rupees per month in Mira Asset India Opportunities Fund, 4,000 rupees in Reliance Small Cap Fund, 4,000 rupees in Banking India Fund, and 3,000 rupees in HDFC Balance Fund.
Okay, and what is the exact question? What is your time horizon of investments?
Ma'am, my time horizon is of 20 to 22 years.
Okay, and any specific goal that you want to invest for?
Ma'am, it is, I want to accumulate a total of rupees 10 crores. Is it possible with the power?
Okay. All right. So Anil, he has a time horizon of about 20 years. He's investing 47,000 in the SIPs. He listed out the SIPs that he has, and he wants to accumulate a corpus of about 10 crores. What would be your advice? And also from the funds he mentioned, do you think that he should hold on to them, or is there any other recommendation in terms of what he should exit and opt for?
Yeah, so I think first of all, congratulations, Saurabh. You've done a reasonably good job at picking your funds. So I have nothing to say about the funds. I think all of them are funds which are doing pretty well. So actually, all of the funds are ones which I would say you can hold or continue to invest. However, I just want to dwell on one aspect which I think you can take some inputs on. The question is, yes, maybe you have a long tenure to go after. However, you see at different points of time, market conditions are different, so you could go through various cycles, and you would find at points, let's say large cap funds do well, at points mid cap funds do well. In the recent past, mid cap and small cap funds have done really well, so your portfolio would have done exceptionally well. However, the point is, from here, what do you look at, right? So we still expect mid-cap funds to do reasonably well. However, over a period of time, we think, slowly the bias will start shifting towards large-cap funds. So my suggestion to you is, while you are doing the SIPs, possibly look at your past portfolio of how much it is built up, and there you can, move between funds a little bit. And I think I would suggest increase the bias towards multi-cap funds. I understand that you can take a higher, risk exposure there, but definitely multi-cap funds can, add some balance to it. Your current composition, which is, 3,000 rupees balance funds, almost like 34,000 rupees in small and mid-cap funds, and you have about 10,000 rupees in a large cap fund. So that ratio, I believe, also you can do a bit of tweaking, and multi-cap funds that you can add as like SBI Magnum multi-cap. You can also add the Franklin India Higher Growth Companies Fund. So these are the two. Nothing wrong with the funds that you have, but maybe a little bit of reallocation. And if you have especially micro cap and small cap funds you have in large measure, then that can be, you can book some profits, move them into partially into multi-cap funds.
Okay, multi-cap funds would be the call of the day, and I hope you were able to take on board all of the advice that was given by Mr. Rego. He's spoken about how the current funds that you've invested in as well have given you some very strong returns. Franklin India High Growth Companies Fund, as well as SBI Magnum Multi-Cap Fund. Those were the two funds that he advised. Saurabh, thanks for sending in your question. Do keep the questions coming on the Money Show at etnow.tv. For now, we take a quick break. On the other side, we've got lots more to discuss, and I want to tell our viewers that we have a very special show that we'll be airing this Friday at 5:30 p.m. How can you protect yourself from credit and debit card fraud? Send in any questions or queries that you may have on the Money Show at etnow.tv. You can also give us a call or tweet to us and send in your questions. We'll have Kalpesh Ashar, who is a certified financial planner, joining in. So any questions on credit and debit card fraud, send them in to us.
Welcome back. You're watching The Money Show, and we have with us Anil Rego from Right Horizon to answer all of your financial queries. And joining us on the phone line is Jagannath, who's calling us from Chennai. Hi Jagannath, thanks so much for calling us. Tell us, what is your question? Jagannath, can you hear me?
It's not Jagannath, it's Pranav.
Alright, I'm so sorry about that. Pranav, go ahead. What's your question?
No, I didn't call you. I received a call from you.
Okay, there seems to be a bit of a mix-up. I think we will be reconnecting then and, connecting with Jagannath, because we do have a question from him. He's hailing from Chennai. He's got a question for you, Anil. But in the meantime, let's discuss some other topics. And so constantly, just the big news headline that we saw on Friday that took the markets to a tizzy was the Moody's rating, and the big upgrade. It's definitely a big thumbs up, a lot of conviction for the government, given that it came after 14 long years. What would you, in just the broader sense, for investors who don't track the equity markets on a regular basis, can you help us understand, or help these investors understand, what exactly is the impact when a ratings agency, gives a positive rating on a country, on the overall macroeconomic picture? What's the impact on mutual funds?
Yeah, definitely. It's been a long wait for us in India here, looking for a rating upgrade, and it has many positives, especially for markets. One is that on the equity funds, you would find that it is positive, because you would have a lot of pension funds and endowment funds which have restrictions based on the credit rating of the country, and based on that they can invest in a country or not invest into a country. Because these are risk measures that their boards have for them. So you could see a lot more money coming in from pension funds and endowment funds which have not had a presence in the country. You would also start seeing lot more confidence that it is conveying to, equity markets, equity investors, the macroeconomic. You would also find that the rating improvement actually ends up, reducing debt costs to companies, which in turn especially who are borrowing overseas, and that could result in cost saving and higher profitability, and therefore the equity returns also could be better. You would also see that because of the better credit rating, again, overseas investors can also start looking at debt funds a lot more actively, and this may again bring down interest rates as a whole, which could both impact debt funds, wherein long-term income funds can benefit. However, what we would suggest is either you look at corporate bond opportunities fund in a better environment, or even a short-term income fund, because long-term income funds can also be volatile on both sides. So this is definitely a great positive both for equity as well as debt markets. However, let's say for somebody who's putting money into bank fixed deposits, for example, it may not be a great thing. So you may continue to see money moving from FDs into mutual funds as a result of this, and that will also end up adding better returns on equities.
Right, so that sheds some light on how these kind of upgrades really impact investments in mutual funds specifically. But I understand we've got Jagannath back with us on the phone line. Hi Jagannath, thanks for calling in. Tell us what's your question.
I'm not hearing from your end. That is the problem. I'm an old man of 86.
Okay.
I'm not hearing from your end.
Mr. Jagannath, can you hear me?
Yes.
Yes, what is your question? We can hear you.
My question is, I want regular dividend in the month of April, preferably mutual funds or equity funds.
Okay.
Right. Which are giving dividend of average 14 to 15%.
All right. So you want to understand which funds you need to invest in for getting regular dividend.
Yes, yes.
All right. Anil, that's his question. Senior citizen, he wants to know which funds to really invest in so that he can get a regular inflow of dividend.
Sure. There are two categories of fund which, again, depending on his risk appetite, I would assume that at this point of time, at his age, definitely it makes sense to not take too much of risk. So I think you can use at the lowest risk, you can use a debt fund and you can use a dividend option. You may even have a few funds which have a monthly dividend, so you could use that for debt funds. You can, if you are willing to take a little exposure to equity, you have the MIPs with up to say 25% equity exposure and rest of it in debt. So you have the benefit of the equity helping deliver better than inflation returns. Again, you could use monthly income plans also could use a monthly dividend, or you could use a annual dividend if you prefer it that way. And possibly the last category that I would suggest for him is the dynamic asset allocation funds that we spoke of. They are also one category that you can use. You also have funds which dynamic asset allocation, and they also use arbitrage to some extent and give you an equity taxation. Both you have equity savings funds also which are sort of closer to an MIP, and dynamic asset allocation funds. Choose those funds which can deliver tax-free returns as well. So that may be another way of helping get a better return and beating inflation as well.
All right, I hope, sir, that we were able to help you out with that query, and I hope you took note of the advice as well that's been given. Time to move on to another query for the day, and we've got an email query. This one has been sent in to us by Nikhil, and all the young ones out there, listen in. He says he's 29 years old, he's a first-time investor, and he wants to invest via SIPs. His monthly outgoings towards the SIP will be about 25,000 rupees. He has a risk appetite that's fairly large. He says, can you suggest some funds to invest in? The nature and the allocation, I would like to diversify my holdings. And I think, Anil, the first step is that the first point would be that he's actually taking a step in the right direction, because more than enough financial experts that we keep speaking to say that it is so crucial and it is so very important to start putting your money into mutual funds via an SIP route. So Nikhil, congratulations on taking the initiative first up. I'm going to hand it over to Anil to guide you on what are the funds in the right portfolio for you. Anil.
Yes, definitely really heartening to look at investors and pretty young first-time investors coming back and actually saying that, you know what, I want to look at SIPs, and this is the perfect way of actually investing. A lot of the time, and even in developed markets, you find, you know, first-time investors burning their fingers and investing lump sum at market peaks. So the SIP is definitely a fantastic way to invest for a person who's just entering markets, and for youngsters. Yes, it is. I would go slightly cautious for him, considering that he is a first-time investor, even though he can take a little bit of risk. So I'll give us a sort of a balanced approach for him. He could use a combination of value discovery, ICICI Pru Value Discovery Fund that we spoke of. He can use again Franklin India High Growth Companies Fund. He could use HDFC Mid Cap Fund, as well as, you know, ICICI Balanced or HDFC Balanced funds. Now, what ratio that he can look at for his 25,000 rupees? I would go a little more tending to the multi-cap fund. So, Franklin India High Growth Companies Fund, I would give 10,000 rupees allocation per month, and the rest of the funds he could look at a 5,000 rupees allocation.
All right, well, Nikhil, hope that you've got all the answers that you wanted and you've noted down all the advice that Anil had for you. But on that note, thank you, Anil, very much for joining us on the show and answering all those queries. And that's a wrap from Avanne and me and from the entire team of The Money Show. But just a quick reminder for a very special show that's coming up next Friday on credit cards and debit card fraud and how that you can really protect yourself. So if you have any specific questions, just send them out. All our contact details are up on your screens at this point, and we'll get them answered by our expert, Kalpesh Ashar.